Worse to come as higher interest rates will crash the housing market. I'm your host, Steven Van Metre, and thanks for joining me today. And experts are warning that higher interest rates are about to hit the housing market with a huge lag and send prices even lower. Let's head over to Wall Street Journal, where we picked today's story up with U.S. existing home sale prices hit record of 407,600 in May as home sales decline 3.4%. Rapidly rising interest rates are rippling through the U.S. markets as the Federal Reserve tries to combat inflation. Stocks entered a bear market this month with consumer sentiment taking a hit, and economists are now forecasting an increasing likelihood of recession as higher rates threaten to choke off growth. But home buying demand continues to exceed unusually low levels of supply and propel prices higher. The median existing home price rose a whopping 14.8% in May from a year ago to $476,600, a record high in data going back to 1999. The combination of rapidly rising rates and record home prices is squeezing many buyers out of the market and making it especially challenging for first-time home buyers. And here's where we start to see supply and demand really kick in. As prices go up, people are saying, you know what, I can't afford it, I'm out, and that will lead to an increase in supply of housing market and, of course, weaker demand, and ultimately should bring prices down. Let's continue on with the story because these factors are cooling off the frenetic sales pace that started 2 years ago when pandemic-related restrictions eased and homebuyers scrambled to find homes with more space. Sales of previously owned homes slid for a fourth straight month, declining 3.4% in May from this time last year. The impact of higher mortgage rates has not been fully reflected in the data, according to the National Association of Realtors chief economist. In the upcoming months, I do anticipate a further decline in home sales, indicating that the worst is yet to come. And what he's saying is these lags are going to hit the housing market. If you think things are bad now, well, just hang tight. Mortgage applications, something we cover regularly on the show, to purchase homes have declined in response to rising rates. Two real estate brokerage companies said last week they would lay off hundreds of employees, which we also covered due to decreased home buying demand. And consumers are feeling pessimistic about the housing market. Only 17% of consumers surveyed by Fannie Mae in May said it was a good time to buy a home, down from 35% a year earlier, and a record low in data going back to mid-2010. And while we don't have the Fannie Mae data, we do have the University of Michigan Consumer Sentiment Survey, and I overlaid that in blue with the All Transactions House Price Index for the U.S., and sure enough, what we can see as sentiment goes down in red, well, home prices on a year-over-year rate of change slow and can potentially even contract during recessions. And here we've seen sentiment, at least not according to the Fannie Mae data, which is not shown here, is at an all-time low, suggesting that housing prices are going to slow and potentially even go down. And how about relating to the stock market? Well, if we take the All Transactions House Price Index and now overlay the Wilshire 5000 or the total U.S. stock market on year-over-year rate of change, what we see again is that wealth effect that we talk so often about. As stock prices go down, what happens is it starts to moderate housing price growth, and in some cases actually can bring it crashing down into negative territory. And so that, of course, is the risk now. We know the Fed is trying to bring the stock market down, slow the wealth effect down, and has higher interest rates for the housing market. That's a double whammy. Again, could send prices down with the worst yet to come. Let's talk about mortgage rates because they surged higher to 5.78%, the biggest jump since 1987, and that is going to start to cool off the housing market as buyers struggle to find properties they can afford. And these higher rates are the result of a shift in expectations about inflation in the course of monetary policy. Higher mortgage rates will lead to moderation from the blistering pace of housing activity that we've experienced coming out of the pandemic, ultimately resulting in a more balanced housing market. And for those of you on the sidelines and been waiting for prices to come back down, that's not what you really want to hear. You don't want to hear more balanced market. You want to hear this thing's going to come crashing down so you can get in. You want to hear rates are going to come back down. And what the experts are telling you, the prices are going to remain sticky and rates are going to stay high. Of course, is that going to happen? Well, probably not. But let's take a look at this week's data. We see the mortgage rates are sitting near 6%, but notably the refinance index is actually starting to fall even further and sitting near ultra historic low levels, but the purchase applications have been rising, pushing the weekly application data up. Now, why is that happening? Because people that have put money down on homes are looking to get those houses closed. They're willing to lock in these rates. They're going to do whatever they take to keep from losing their home that they believe is only going to go up in value. But where are rates headed? Well, let's dig into the data a little deeper, because here we've got the U.S. Mortgage Refinance Index, and you notice I'll circle some low points here, kind of mid-2015, early to 2017, kind of late 2018, and now. And let's take a look at interest rates here. We have the market yield on 30-year Treasury securities, and notably kind of mid-2015, what happened? You see a peak at rates, and then they started to head lower. How about early 2017? Rates peaked and head lower. Early 2019, rates were already coming down and went down a lot. And of course, now we're looking at the same arrow pointing down, because if rates are too high and demand for loans go down, and you're a bank and your job, your business is selling people loans, well, what's going to happen to rates to bring people back to the housing market? Well, they've got to head lower, and that's real key here to what happens. Now, if you're concerned about what a housing market blowup could mean to your portfolio, and you're not sure if your portfolio has the ability to hedge that kind of risk, well, I'll put a link up here to Portfolio Shield and the description below, a unique strategy that can hedge risk unlike many others. Let's continue on, because home prices look to head lower as U.S. house prices are likely to drop as rates continue to rise, according to capital economists. Housing prices could contract an annual 5% by the middle of next year, according to a senior property economist. He previously projected no change in values by that time. An average household looking to buy a home for the median price will now have to put more than a quarter of their annual income toward mortgage payments, according to the report, which surpasses the average 24% seen in the mid-2000s. This is real important to understand, because we keep hearing about all this pent-up demand and all the consumer demand that's going to go out and eat up all this inventory. It's going to travel the world, and it's just going to consume. And as people enter the housing market, what you're finding out is almost 25% of their income is going to be tied up in housing, meaning they're going to have less money to spend on other parts of the economy, bringing demand down. And now you see how housing can lead the market up, the economy up and down. The deterioration in affordability will shut many potential buyers out of the market, which it already has, and that will reduce the competition for homes, and sellers will eventually see the need to accept a lower price for their property. And at a time when investors, according to the Wall Street Journal, are starting to get nervous about their housing bets as the market is on shaky foundation. Just as some home buyers are still willing to pay record prices, investors continue to plow large sums into residential property. Since January, they've spent roughly $103 billion on U.S. apartments, following an unprecedented $319 billion splurge last year, according to recent data. Institutional buyers see it as a steady bet, especially since remote working has made it riskier to own offices. And stock investors are already much more cautious about housing than private buyers. Share in U.S. Residential Real Estate Investment Trust, which is currently one of the hottest products in the market. Money is pouring in to REITs, but check this out. As what we find out, that these are currently trading at a 22% discount to gross asset value, a good proxy for where investors think the value of underlying real estate is headed. Well, European shares imply a 26% fall in property values. So if those numbers are right, well, it means prices are coming down. As interest rates go up, property owners are becoming more dependent on growth in rents to deliver decent investment returns on their expensive purchases. But there's only so much that squeezed tenants can afford to pay, and landlords may soon find homes less comfortable. And during recessions, when people lose their jobs, of course, their ability to pay for their rent and other things, as we know back from the great financial crisis, well, that diminishes, meaning all these investors could be stuck with houses that they can't unload, because the housing market compared to the equity market, well, it's very illiquid, as we know. And more homes are likely to come on the market as for sale. This report finds is active listings, which refer to all homes in the market during any given period, rose 5% during the week that ended in May 14th compared to this time last year. And new listings, which refer to homes first placed on the market during a given period, rose by 6% that week compared to this time last year. And what does all this mean when we see the housing market slow down? Well, you probably guessed it. We've talked about this on the show before. We're going to see headlines like this start to show up, where you see as real estate market cools, so does the market for agents. It's not just agents. It's going to be people in the mortgage business. It's going to be appraisers. It's going to be builders, construction workers. It's going to be tradespeople across the board. This is going to have a devastating effect on the U.S. economy, which is why the housing market's so critical. And what doesn't make sense, despite as hot as the market is, the Fed is key on raising rates. They're driving up interest rates on mortgages. That's crimping buyers and likely to send the housing market down, along with the U.S. economy. And that's how you know the worst is yet to come. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.